Welcome to Money Matters. I'm Sarah Peterson, here with Dean Greenberg of Greenberg Financial Group. How are you today?
I'm great. Every time I'm with you, Sarah, I just love it.
I mean, you just make me smile. You always make me smile.
I always ask for you. You know that. I want you to be my host with me. You're smart. You know what you're talking about. You're from New York.
Yeah, I was going to say,
you're
reading the biggest thing out.
And you got the same energy I do.
Two New Yorkers. How could you go wrong with two New Yorkers?
The only thing is we should make pizza with our hands or something. We talk so much.
I like it. I love it. I'm all about the pizza. I want to talk about, speaking of New York, I love this. You love to educate people, and you have these radio shows we listen to, and you talk about subway logic, and I want you to talk a little bit about it.
I've used this thing for probably 30 years. It's like people look at stocks or they look at their plans, and they always think, oh, what do I do? How do I do it? Well, if you look at a subway, right, if you think about it, when I was in New York, or if you go to New York even now, and maybe you don't get on the subway now in New York, but you used to when it was safe, you'd get on at 20th Street, right? And you got to get to 40th Street. So if you get on the subway at 20th Street and you get to and you get to 40th Street, you get off. You don't think about it where that subway goes later. Does it go back to 20th? Does it go to 60th? Does it go to 100th? You don't know. You don't care because it got you to where you want to be. But if you get on that subway on 20th, and now you look at the window after it stops and it says 10th Street, now you have to make a decision. Does this train turn around and get me to where I need to be at 40th Street? Or do I have to get off this train and get on a different train to get me to 40th Street? And that's how I look at stocks. That's how I look at plans. You put a plan together, you manage money, you do what you need to do, and if you get to that point, you just continue your trip. You continue what you're doing. But if it doesn't, you have to think about it. If what I'm doing is correct, is my game plan correct, or do I have to change it? And sometimes it's not wrong because of you, it's wrong because of what's happened in the economy, in interest rates, or different things like that. And nothing can be static anymore. You used to say, just buy and hold. You can't do that anymore because everything is changing. Like you said earlier, social media has changed everything. People's appetites have changed so quickly on everything that they want and anything they do that industries and stocks and the way they feel and all just is different.
I kind of call it the ADD generation. I mean, I don't know that I had ADD growing up, but I probably
you did. You did.
Really? Is that where we're going? But I feel like I have it now because we're constantly, you can check this, your phone and your text and this, and I see how the kids are, and it's this generation of just, there's no focus, there's no attention. So how do you create this bigger, greater, grander plan if you can't even focus on, one portion of it? We really need to take all the parts of this picture, right? And then sit down and have a conversation that's going to plan for all these unknowns.
Well, the hardest thing is, but one of the things we try to do is we always keep focusing on what's at the end. What are they looking at? Where are they going? What do they want? And keep bringing that up and reminding them. You're not getting there in 6 months or a year. It's going to take time. Like even young people that come and work with us, okay? It's like, guys, it's 3 to 5 years before you start even trying to make some money, okay? It's different now. They get salaries. When we joined the business, as you know, with your husband, it was all commissions. You made what you made, and that was it. They couldn't care less if you didn't make money that month and you couldn't pay your mortgage. You had to work. I'm glad the business has changed, and that's what I mean, changing. The subway's still moving forward.
Well, yeah, and I think the one thing is that, change is inevitable, right? And it's not the change that's the problem, it's being prepared for it. So it's not like you make a plan and it's written in a Sharpie and you can't change it. It has to be evolving, it has to be updated. We have to look at these things on an annual basis or more than once a year. If you haven't talked to your financial advisor since prior to 2020, that's a problem because I can guarantee there's been a lot of change between 2020 and 2023 for everybody, whether it's been loss, whether it's, something in your health, something in your jobs, your career has changed, whatever. We've all experienced it. And it's just about being prepared for it.
Well, obviously the biggest change is inflation, as we know. Okay, costs have gone through the ceiling. Homes have gone through the ceiling. Most of us that have children are concerned about how do they pay for things. You know what I'm saying? So even though, we say earn what you get, if we're in a position, we as parents want to help our children. But that drains our retirement, so.
Trust me, I don't even want to go there because I am so terrified for the whole generation, not just for.
You still have young kids, don't you?
I have young kids, but my oldest is in high school, and I see the way that these kids, they watch Instagram and Facebook and TikTok and all these things. They think, oh, that person just did this, and they're famous, and I could do that too. It's this instant gratification generation, and just the world doesn't work
And they
like
don't realize what they do now could hurt them later on.
100%.
You know, but going down that road, though, the plan is so important. You
But
know,
the
a financial
plan-
plan, retirement plan, distribution plan. There's 3 different plans that you got to go through your life with, and they can all be at one. If you're 65, 70, you just retired, well, you have a financial plan. You got to put your retirement plan in, and now if you're trying to distribute money, you have a distribution plan. And people don't break them up. A financial plan. I look at each one as a little bit different and they could all be at the same time.
So if you're sitting down watching the show and you're thinking, okay, I haven't spoken to a financial advisor about any of these things, I'm approaching retirement, or maybe I have a financial advisor who hasn't discussed anything with me, maybe like I said before 2020, it's a conversation that we all need to have, and it's really education, right?
It's education. We sit down with them. It's getting to know us. It's a trust. A lot of people we're dealing with, too, have advisors that are retiring and they're moving on to like their sons or different people, and they don't know them anymore because they moved to Arizona. And we've been getting a lot of people coming in and say, I want to be with somebody I can come in and sit down with. And, you know, listen, we don't charge. It's free. You come in for your financial plan, retirement plan, it's free. We tell you what it is. I'm not going to say I don't want to do business with you, because of course I do. Otherwise, how are we in business? And how would I be in business since 1988 in Arizona if I'm not doing a good job?
You're not old enough for that.
Okay? But that's the key. That's the thing. That's it at the end of the day. And we have young people in our office that my son is in there, Dylan, which comes on the show and stuff. And we're on the radio together, and they hear us on Saturdays, and they hear us on Sundays. We give out our advice for free. It doesn't cost anything to listen. What costs money is if we manage your money, and that's done on a fee-based business.
And it's all very transparent, which I love. But I think that the thing that makes you so different is you get to know people for who they are. You're going to come to me and say, Sarah, how has your daughter? How's your son? You know, are they still on the football team? I want that so that I can tell you what my dreams and goals are as a separate picture from just what the money is, because that's what it's all for in the end.
See, speaking with your financial advisor, like you said, 20. And if you have a financial plan, that's too long. The money management part, the portfolio management, that's not too, you know what's going on. You see your statements, you can call on the phone, that stuff. You don't have to go see them all the time if you don't want to. Because we have a lot of people, we relieve their stress. They've been with us 10 or 15 years. We relieve their stress, they're 80 years old, 75 years. They don't want to come in all the time. They know the market's down, they know we're handling it. As long as they get their check every month that they can live on, because we set up that income plan for them.
Well, I want to make sure that they have the phone number before we need to go to a quick commercial break. That number is 844-544-4909. We're going to come back and talk more about the retirement income gap. We hope you'll stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. And before break, we were just about to start about the retirement income gap. And I want you to explain this because
But before we get to the retirement income gap, there's something you got to do. You got to do a budget and how much you spend.
He used the B word. I hate the B word.
I know. I cannot see you on a budget. There's no way you're on a budget. Your budget is, I got a credit card.
Honey,
my
if you're listening,
I haven't hit my limit yet. They accepted it.
Dean, zip it. Okay, seriously, a budget, maybe is that one of the reasons why people don't want to come in and sit down?
People don't want to come in because they're afraid. They're afraid because they don't know what it is. But now people talk about it, not just us, a lot of people, big companies are talking about it, the plan. So they see it, they're not afraid. So the second thing is, they don't think they have enough money. And that, to me, is not the reason you do a plan. You might not have enough money. There's people that we talk to.
If you don't have enough money, don't you want to know?
But at least then we tell them, you're going to have to live off your pension. This happens with the Fed. And your TSP, this is what you're going to be able to get from it. And you're going to have to stop spending so much. They might not like that, but that's what we're going to tell them. Or you're going to have to do something with whatever you have here to kind of grow, and this is what we can give to you. And we'll get to that.
This is like the fear factor, though. And I mean, it's like you can't lead your decisions by fear. The fear of the unknown. I don't want to know if I don't have enough. I don't want to. Right. Wouldn't we want this information so that we can turn around and make a better plan?
And there's right, exactly. So you have to do a budget, and you have to know how much you're going to spend in your lifestyle. You do. And then if your spending can't meet your budget, then how are we going to meet the income gap? All right. And I'm not, and the idea from that is there's many ways to do it. All right. One of the things we're doing with fixed income now, interest rates at least over 4% for 1 and 2 year treasuries. Safest thing you can have, government bonds. So what we've been doing is setting up what's called bond ladders, so they can go get that income off things that we feel are going to be pretty safe. All right, government bonds. But then what do you do if things turn around, the economy's good, and interest rates come down? Well, you can't keep rolling those at 4%. So what we've been doing is taking half and putting it in there, and then we take the other half and we put it in a fixed index annuity. And if they're going to need income, we put an income rider on it, and we do a 5 or 7 year deal. So we know we can keep rolling those bonds, but in 5 years from now, they're going to have other money to make up the difference if interest rates are lower. And if interest rates are lower, that means the economy is good, which means the fixed index annuities are going to make money.
Hasn't it been a really volatile bond market this year, though? I mean, we sort of looked at bonds as an indicator for other things, and it hasn't quite worked the way it has.
If you weren't in short-term bonds, you got your butt kicked in, okay? It's that simple. That's why we went to 1 and 2 year bonds. But now they're there. They're paying us 4.25%, 4.5%. That's why we're staying there. But we also know we have to be smart. We don't, if you go out to 5 year treasury right now, you get 3.5%, which is not bad. But if you're going to fixed index annuity, and this is money that you have in your bank account, you don't have to pay taxes. It'll be tax deferred for you. It'll also maybe grow more than 3.5% possibly. Worst case scenario is you break even off of it, and then you have to go from there. But I believe the markets are going to do okay. And, annuities are complicated. You got to understand them, and you got to go to somebody that fits it in with your plan. A person that just sells you annuities is not a planner, okay? They're selling you annuities, and they don't care how much of the money are. You're just going to take as much as it is, and they're going to tell you, you can't lose, this is what you can get, and go there. That's ridiculous. You've got to sit down and see where it is, because you need liquidity. You need an increase. The reason we're using them is I think that if the economy gets better, okay, for it to get better, they got to lower interest rates. Well, if they lower interest rates, you can't get those on your corporates and your treasuries, but then that means your fixed index annuity will go higher.
So, I mean, to me, it's like a domino effect. These are all things that come into play when planning, but if I create my plan with you in 2023, and then the bond market goes sideways or different things change, that's why you're revisiting the plans. That's why you're making everything so that it's evolving with the changes.
If interest rates stay up, that's great. You keep your index annuity, you keep rolling the treasuries at 4%, and you keep moving along. If they go higher, you roll them at 5%. Yes, that's what you do. You have to, you put a plan in place and you change it as it goes if you need to. But you have to have a plan from the beginning. Everyone just forgets about fixed income, to be honest with you. They just think it's this or that. And I guess I know why, because from 2010 to 2020, you couldn't get anything on fixed income. Bonds just kept going down to zero. So you had to find other ways to do it.
But, okay, so how different is the planning process for somebody like me? Sort of midlife, we won't go into specifics on age, but with a family, with a lot of financial needs, in the accumulation phase, how different is it going to be for me now than it is going to be in 20 years?
Well, and your plan's going to change, but you're 35, so by the time you get to 65 years old, that's a 30-year change, okay? And you got plenty of time now to keep putting money away and doing things, but your kids are going to go to college. It's a fortune, okay? And you unless you stay in state, which is still way expensive, more expensive than it was before, it's going to cost money. And college is not, in my opinion, college is not what it used to be. All right, it's a joke the first 2 years of going to college, and then you can't even get your classes at some of these, and so you have to be there 6 years, and they've set up the game. So, there's a lot of different ways, but there's going to be so much more cost involved that how are you going to put it away? What are you going to do? And then, in 25 or 30 years, you hope that you have enough money put away because you're not getting a pension, all right? And you're going to just have Social Security.
It was just so much more simpler for our grandparents, wasn't it? I mean, they just had their pension. Everything was just so planned out. They didn't have all the modalities that we have now, all the vehicles. It's a different world. It's
well,
a
that's why
different
the
way to plan.
corporations got rid of pensions. They were always underfunded. All right? So unless you work for a government agency or you work for the state, very few pensions, corporations have pensions now.
Here's the deal. You graduate, hopefully, like we're talking from whatever university it is, you get a good job and they offer you a 401k. You might not have any idea where that's being invested or what that bigger picture is. And to me, this is an education that we all need, no matter what age you're at. We need to start from right when you get that first job, first paycheck, planning for the future. It is invaluable. That phone number is 844-544-4909. I could go on and on and on. Please stay with us, and we're going to talk more about how your money matters.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. By running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. Before the break, we were talking about 401ks. I don't know why this topic is always on my mind too because I have kids, but I don't understand why it's not part of our formal education. Nobody says, hey, here's how you're going to create your own financial plan. Because when we get a job, our first, formal job out of school, and they give us a 401k, yay. But okay, where's that money going? And
not only going, they don't even understand it. All right, so a lot of people that come in and do a financial plan with us when they're younger, they got 401k plans. We help identify how to invest in that 401k plan. We don't get paid for that. It's already there. But we want them to do the best. Most of them are so wrong because there's a risk tolerance, and it might be too risky for them or no risk at all.
Well, let's talk about that. Who really knows how much risk they're taking? What percentage of people come to you?
They don't in the 401k because they got some guy that sells them a 401k plan, right? Could be an insurance company, could be a brokerage firm, could be whatever. But you got 100 employees there. How does every employee know exactly that's the right place for them? They got to go to somebody and let them figure out what their risk tolerance is, how it should be set up, how does that 401k plan fit in. So many of them just go borrow money against it when they have credit card bills and some things that happen. To me, that's the worst thing to do. I know some people say, oh, it's great, they pay themselves back. But if you're borrowing when things are bad, it's usually because the market is down, right? So you're taking it out to pay bills to be able to pay bills when the market's down, and now you're going to add back in, but now the market's rally, and you just took out whatever you took out, half of your 401k plan. It doesn't get back to where it needs to be. If you when things are good and you're taking money out because you want to get a house and they're appreciating assets, I get it. But if they're just depreciating assets, I don't get it. Stop spending. Do something to cut down that. It's just like the government. Everyone says the government should keep spending. I don't. I think it's a problem. And we'll see what happens.
Somebody's going to pay for it. I mean, where's the money go?
Right, but no one teaches them. Yeah, they have someone come in and talk to you a little bit about your 401k. You want to go see them? No, but what do they know? They don't know anything about it. And then all of a sudden they have this money. They roll it to another 401k. Don't ever roll your 401k to another 401k. Roll it to an IRA. Your options are so much more for investing. And then you're dealing with a financial advisor that can help you through that and figure out what your risk tolerance is and figure out what your goals are and make sure it's invested that way.
Nobody is sitting down with you when you're getting that first 401k. Oh, Sarah, tell me, what are your dreams and goals with this money? How many kids do you want to have? How do you see your retirement? You're just checking a bunch of boxes on a form. I want someone to look me in the eyes and understand that this money means my livelihood, my freedom, and all the things that we work so hard for. We should be able to enjoy.
Build a relationship of trust. Okay?
Can you help me enjoy my retirement, please? Can we do all these things so that someday we get that margarita on the beach?
But you don't want, so many people want to wait to that exact retirement. I always try to get them there beforehand.
Okay, what's the perfect time?
There is no perfect time. The perfect time is when you can get to the point you're some exercise. So say you're investing money, right? And you're in your 50s. And you say, I'm not going to do anything until I retire and I'm going to be 66 or 70 years old. All that time you have your health. You have the ability to do stuff. It's a balance. We make sure in our plans we give a balance to our people. All right? We want them to do things. We want them to do things with their kids when they're there. Why wait till they're out of high school and say, no, I get it. If you can't afford it, you can't do it. But if all of a sudden you make, $100,000 in the market, take $25,000 and maybe go do something that will teach your kids something, mentor your kids, do something, because experience is everything. I see way too many people get sick. I don't know why so many people are getting sick lately, but they're getting sick, all right? And it's not, and maybe it's because I'm older too, and you see it, but people are just, there's things happening, and to me, the greatest thing for children is when parents give them experiences, when you can afford it, whatever experience is. Getting in a station wagon and driving to Florida, I love that. Every year we did it with my family. Driving to Florida, 2.5 days, staying at Howard Johnson's.
It's funny that you said that because we're going to take our first ever family trip to Europe this summer. And I called a travel agent and asked a couple questions about booking the flights. And her first question to me was, what's your budget? And I don't know why it struck me, but I said, well, I don't work that way. I want to know what's what's fair and reasonable, and obviously want to get the best price. I have 4 children. I don't want to spend all the money on getting there. I want to spend it on when we're there, right? But it really did strike me. It's always...
I don't ever want someone to say, what's your budget? Because then I'm thinking, okay, well, they're going to give me the most expensive thing for them.
100%.
I want the biggest value.
That's exactly it.
Okay, and most people are that way, and they don't do that all the time. That's how I want to come across to people. We're going to give you value.
100%. And also what makes you different is that you're a fiduciary. It's different than working with somebody, right?
I just laugh at that. You know why I laugh at that, right? I started my business in 1988. I sat on the other side of the table, and I said, what do I want if I'm a client? Client comes first. The product's got to be right for the clients. Work for a fee. Every day I look at that, I set what is done for the client. Now all of a sudden, because there's some legal ease regulation to be fiduciary, if I wasn't a fiduciary in '88, why would I be thinking that I'm a fiduciary now? I'm always a fiduciary. The client, best interest, always needs to come first.
Yeah, but you've said it yourself before that some people will sell you only their products.
Right.
And that's not being fair and honest,
But they're not fiduciaries.
Right.
the salespeople.
But just, it sounds logical that everyone would want to work that way, but we're in a world where not everybody does.
Right.
Unfortunately. So it is like a good question to ask. If I'm sitting on the sofa right now, I'll tell you, it's very hard to pick up that phone and make that phone call. You know why? Because I might not want to hear what your answer is. When I sit down with you, you might tell me, Sarah, you should have started planning 10 years ago. But guess what? I would rather know that than not know it. So I can make the changes.
But it wouldn't come across that way. It'd be a little different. Sarah, you're smart. You know where you're at, okay? So what we need to do is figure out how we're going to get you to be able to take not one, but 2 trips to Europe with your family. So this is what you're going to have to do. You're going to stop buying all that gold jewelry. No, but seriously,
Again,
we would never
Dean.
put somebody down. You never put somebody down. All you do is say, here's our picture. This is what we got to do to go forward. You can't do anything about the past.
100%.
Okay? But spending is everything. All right? People don't think that, but it's true. You got to look at what you're spending, where you're spending, and if it's like on the things you need to live on, essentials, then we got to figure out how to get you more money.
I once heard a great financial advisor, who shall not be named, my husband, say that, you know, making money is not the hard part, it's keeping it. And it's always struck me on that, because he's right. I mean, so many people make a lot and lose a lot, and you hear all these celebrities, they went bankrupt and they had millions and millions, and the people that spend smart and save and plan are the ones that ultimately get to enjoy their lives. And that's really what this is all about. We want to get to those golden years. Why else would I be working
And when
so
are they?
hard?
Are they your 50s, the 60s, the 70s? You know what I mean? So to me, is your golden years is when you can start affording to do stuff. Now, maybe when you're 45 or 50, you can afford to do this. And that's what you can spend. And maybe by the time you're 65, 70, you can spend more. But I'm telling you, if you keep waiting and getting stuff, I've seen it too many times. People's health decline, things happen. Your spouse isn't around. I mean, you know, everyone thinks when your spouse passes that you're so much richer. No, you know, your expenses don't go down by half. Okay, your rent is still the same, your mortgage is still the same, your insurance is still the same. The only bill that goes down might be your food bill.
Well, exactly. Well, I want to make sure that we give the viewers that phone number. It's 844-544-4909. You keep throwing around the word free. I always love to say, I mean, this is just a complimentary education.
Free. We're going to do it for you. It's the best thing you can happen.
Educate yourself.
Educate, educate, educate.
It's always fun, and we always run out of time. Please join us on the next show so we can talk more with Dean about how your money matters.